What does a struggling Philadelphia office landlord have in common with, like, a cutting-edge Silicon Valley AI firm?
I mean, on the surface, absolutely nothing.
Right. But right now, in early 2026, both of these companies are intentionally destroying millions of dollars of their own revenue.
Which is wild.
And they are doing it entirely just to survive.
It's a brutal strategy, but honestly, it's fascinating. We often picture corporate transformation as, a ribbon-cutting ceremony for a shiny new product.
Yeah, lots of fanfare.
Exactly. But the reality is usually a massive demolition project. You have to aggressively tear down the outdated structures, clear out the debris, and, well, take a short-term financial hit before you can actually build something designed for the future.
Welcome to today's Deep Dive. Our mission is exploring the mechanics of these make-or-break corporate transitions.
And to do that, we've pulled a stack of sources featuring fresh earnings transcripts and market research from two completely different entities.
First, we have Brandywine Realty Trust, which is a massive commercial real estate company. And second, 8x8 Inc., a cloud communications and AI software developer.
Which seem completely unrelated. But for you listening, if you want to understand where the modern economy is heading, looking under the hood of these two specific corporate engines tells us a profound story about the state of physical versus digital workspaces today.
Okay, let's unpack this. Let's start with our first company, Brandywine Realty Trust.
Let's do it.
We're looking at their Q4 2025 results, which they reported in February 2026.
Right, just recently.
Yeah, and the headline numbers are surprisingly resilient. Like, revenue beat expectations, coming in at $120.95 million.
Which is pretty solid.
It is. Now, they did report a GAAP loss of 21 cents a share, but
their funds from operations, or FFO, was perfectly in line at 8 cents a share.
Right. And for you listening, FFO is really the pulse of a real estate company because it strips out paper losses like depreciation.
Yeah, nobody really cares about that paper stuff.
Exactly, and it shows us the actual cash the buildings are generating.
And those cash generation numbers exist in a highly challenging context. I mean, the macro environment for commercial landlords has been notoriously battered over the last few years.
Oh, absolutely. The standard narrative is that office real estate is just a sinking ship.
Yeah, pretty much.
But let me play devil's advocate here, because their transcript reveals they're doing the exact opposite of abandoning ship.
They are leaning in.
They really are. Brandywine is actively buying out their partners' preferred interests in prime Philadelphia assets.
Specifically 3025 JFK and 3151 Market Street, yeah.
Right. So wait, buying more office space in 2026, isn't that just catching a falling knife?
It sounds like it, yeah.
I mean, it sounds like they're trying to sell first-class tickets on a sinking ship, yet their mark-to-market rental rates are up 20.9% on an accrual basis. How are they pulling that off?
Well, what's fascinating here is the underlying mechanism of their strategy. Management calls it a flight to quality.
Flight to quality, okay.
Yeah. They aren't buying just any office space. They are consolidating ownership exclusively in heavily amenitized, premium Class A buildings.
So the really nice stuff.
Exactly. Spaces that feature life science labs, high-end collaborative hubs, and, top-tier locations. The market isn't abandoning the office entirely.
It is just abandoning the mediocre B-tier office park.
Nailed it.
So they're betting that companies will pay a premium for a physical space that actually makes employees want to leave their houses.
And the data in their transcript totally backs that up. You mentioned their mark-to-market rental rates are up 20.9%.
Yeah, on an accrual basis.
Right. That means when old leases expire, they are signing new ones at roughly 20% higher rates. You only get that kind of pricing power if demand for your specific product is incredibly high.
Wow.
And their core portfolio reflects that demand. It's remaining solidly occupied at 88.3% and 90.4% leased.
That's way higher than I would have guessed.
Same-store net operating income actually increased. But, to your earlier point about catching a falling knife.
Yeah, the debt.
Right. Funding these buyouts requires a masterclass in capital discipline. This isn't really a story of explosive growth. It's about operational stability and liquidity preservation.
Right, because how does a real estate company fund these massive premium buyouts without drowning in debt, especially with interest rates where they are?
Well, if we connect this to the bigger picture, Brandywine is managing their liquidity with, surgical precision. They highlighted having zero borrowings on their $600 million unsecured line of credit.
Wait, zero?
Zero. And they have completely cleared their immediate runway by pushing off any bond maturities all the way to November 2027.
Oh, wow. So they don't have a debt cliff hanging over them this year.
Exactly. They gave themselves breathing room.
But they still need capital, right, to fund the buyouts. And they also mentioned recapitalizing their joint ventures down in Austin.
Yeah. So they are funding the future by liquidating the past. Brandywine is planning $280 million to $300 million in asset sales for 2026.
So selling off the B-tier stuff.
Exactly. They are intentionally shedding their non-core aging assets. They'll take the capital from selling those mediocre buildings to pay down debt and secure 100% ownership of their absolute best properties.
So they are shrinking their overall footprint to dramatically strengthen their foundation.
That's the survival tactic.
Which is a perfect segue, because to see what this kind of demolition looks like in the digital world, we can pivot directly to our second company, 8x8 Inc.
Yeah, let's talk about 8x8.
So if Brandywine is stabilizing physical real estate by selling off non-core buildings to protect their premium assets,
8x8 is executing the exact same playbook with their software.
Taking out the trash to focus on the future. Let's dive into their Q3 2026 earnings call. They posted record service revenue of $179.7 million.
Which is up 3.6% year over year.
Right. But the real standout event of the quarter, the real drama, was the deliberate final shutdown of their legacy Fuse platform on December 31st, 2025.
And that decision carries massive implications. I mean, they acquired Fuse 4 years prior, and it brought in over $300 million in cumulative revenue over that time.
Well, that's a lot of cash.
It generated the critical cash flow 8x8 needed to invest heavily in their own next-generation AI innovations.
But then they just killed it. The transcript notes that pulling the plug on Fuse caused a near-term service revenue headwind of about $4.5 million in Q4.
Yeah, due to churn.
Because not every Fuse customer migrated to the new 8x8 platform.
Right.
Some just churned out.
Right.
Wait, so they bought a company, migrated customers for 4 years, and then literally pulled the plug on the old system, losing customers in the process.
Yep.
That's like buying an apartment complex, tearing it down to build a smart home, and being totally okay with some tenants moving out.
That is a perfect analogy, because the alternative is just a slow death by technical debt. Well, maintaining two separate tech stacks is a massive drain on engineering resources, server costs, customer support bandwidth, you name it. By ripping off the Band-Aid and forcing the transition, 8x8 can now channel 100% of their energy and finances onto their modern platform.
They eliminate the drag of duplicate infrastructure.
Exactly. And the proof is in the margins. Their operating income for the quarter hit $21.7 million.
Oh, wow.
Yeah, that translates to an 11.7% operating margin, which absolutely crushed their own guidance of 9 to 10%.
That's huge. And beyond the margins, they used the cash generated along the way to aggressively deleverage, just like Brandywine did.
Right, paying down debt.
Since August 2022, 8x8 reduced their debt principal by $224 million. That is a whopping 41% reduction in debt.
Which is massive.
Yeah, cutting their annualized interest expense by more than half.
So with the legacy tech gone and the balance sheet secured, their focus shifts entirely to what is actually driving their growth.
Which leads to the question, with the legacy tech gone, what is 8x8 actually selling now?
Well, we are seeing a fundamental evolution away from the traditional software as a service model, or SaaS.
Here's where it gets really interesting. Buried in the transcript is a staggering metric. 8x8's usage-based offerings grew 60% year over year.
60%. Let that sink in.
It's crazy. These usage-based offerings now make up 21% of their entire service revenue.
Up from the mid-teens just a year ago.
So what does that actually mean mechanically for a customer buying their software? Are we looking at the death of pure SaaS?
It really looks like it. Historically, the gold standard for tech companies was getting a client to sign a rigid multi-year subscription for a set number of licenses.
Right.
And that was regardless of how much the client actually used the software.
The classic shelfware model, where you buy 100 licenses, only 40 employees actually use them, but you pay for all 100 anyway.
Exactly. But the market is aggressively rejecting that model now.
Yeah.
Enterprise customers want guaranteed return on investment. They're shifting to hybrid, tokenized, pay-as-you-go models.
So paying per action.
Yes. If a company uses an 8x8 voice AI bot to verify an account number or process an Apple Pay transaction. The company pays a microtransaction fee for that specific API ping. They only pay for the actual outcomes generated.
Which heavily reduces the buyer's risk when testing out new AI tools. But man, that forces 8x8 to constantly prove their worth.
Totally. If the AI doesn't work, the usage drops and the revenue just disappears instantly.
It's a high-stakes game. And it actually sparked a really intense moment during the Q&A portion of the earnings call. Analyst Josh Nichols asked CEO Samuel Wilson about their gross margins.
Because they were trending down slightly. Yeah. To 64.8%.
Right, as this usage-based revenue scales up. And the CEO practically jumped on his soapbox to answer this.
Oh, I loved that part. The CEO's response dismantled a very common misunderstanding about consumption business models.
Yeah, he explained that usage-based models have structurally lower gross margins because there is no unused shelfware heavily subsidizing the server cost.
Exactly. You're only billing for what is consumed,
Yeah.
and each consumption ping carries a tiny compute cost.
But he also noted that while the gross margins look slightly lower, the operating margins scale beautifully.
Right, because once 8x8 finishes building the underlying AI and API infrastructure, every additional transaction drops straight to the bottom line.
Without requiring new sales or marketing spend?
That operating leverage is exactly why we saw that huge 11.7% operating margin beat. And that massive surge in usage is being driven heavily by AI.
Right. 8x8 noted voice AI interactions increased by more than 200%.
Which is an enormous volume of inquiries, routing calls, and processing payments.
So what does this all mean for human workers? I mean, if AI is taking over answering questions and processing payments, and bots are absorbing a 200% increase in workload, aren't human contact center agents losing their jobs in droves?
This raises an important question, because logically that's what you'd expect.
Right.
But the data provides a highly counterintuitive answer. During an exchange with analyst Peter Devine, the CEO revealed that 8x8's total contact center seats.
Meaning the actual licenses bought for human agents.
Exactly. Those seats actually went up both quarter over quarter and year over year.
Wait, really? AI usage is skyrocketing, but companies are simultaneously buying more seats for human agents. Make that make sense.
It comes down to the distinction between micro and macro tasks.
Okay.
Currently, AI is heavily deployed for micro use cases. Imagine calling a massive healthcare network. The AI answers, verifies your date of birth, checks your basic insurance status, and pulls up your patient ID.
Taking a serial number or processing an Apple Pay bill.
Right. Those are micro tasks. They are repetitive, simple, and high volume. The AI handles the upfront friction, which heavily reduces the mundane portion of the call.
So the human agent doesn't have to waste 2 minutes just spelling out my last name.
Exactly. They get to bypass the administrative setup entirely, which drops call handle times. But human agents are still fundamentally required to handle the complex, empathy-driven problem solving. The human takes over to negotiate a complex billing dispute or, calmly walk an elderly patient through post-operative care instructions. Because the AI filters out the simple calls, the cases that actually reach the humans are much more complex.
Which drives customer satisfaction. Companies aren't firing agents, they are repurposing them to handle the tough stuff. That is why the overall demand for human seats continues to rise.
And understanding that human element is also the secret to how 8x8 actually wins these contracts in the first place.
Yeah, because how are they closing these deals in a highly competitive market against massive giants like Zoom and Wing Central?
Having a great AI algorithm isn't enough anymore. Advanced technology is rapidly becoming just table stakes.
Right. The real differentiator is the sales strategy. The transcript highlighted some massive, very specific wins.
Oh yeah, they landed a regional healthcare system with 850 employees.
And a national early education provider with over 43,000 employees. And they expanded with a large pet hospital company. But how does a company like 8x8 beat a giant like Zoom to win a complex healthcare system?
They did it by going entirely old school.
Really?
Yeah. In the case of the healthcare system, 8x8 explicitly noted they won the deal because their team actually went on site when their competitors refused to travel.
They literally won a cloud AI contract by physically showing up in the building.
They showed up, walked the floors, and demonstrated a deep, nuanced understanding of patient care operations. They provided industry-matched references. They didn't pitch themselves as a software vendor just tossing code over the fence.
They embedded themselves as a strategic partner.
Exactly.
For you listening, whether you are pitching a new project internally, running your own business, or trying to understand enterprise sales, there is a massive lesson embedded in that victory.
A huge lesson.
In an era obsessed with AI and digital metrics, physically showing up in person and acting as a strategic partner still beats having the flashiest algorithm.
Because physical presence builds irreplaceable trust. In a business environment moving rapidly toward those pay-as-you-go consumption models we discussed, trust is your only moat.
Yeah, if the client doesn't trust you, they simply stop pinging your API and your revenue drops to zero instantly.
And that foundational trust is what drives 8x8's highly successful multi-product strategy. When you build trust in person, customers don't just buy a single voice bot, they buy the entire communications suite.
Oh, right. 8x8 noted that customers with 3 or more products generate 3 times the revenue of a 2-product customer.
The financial multiplier there is huge. You scale revenue exponentially when you become an indispensable, trusted platform rather than a disposable single-use tool.
So wrapping this all up, the common thread binding this entire deep dive together is the ruthless prioritization of high-value premium relationships, both physical and digital.
Absolutely.
From Brandywine surviving the brutal commercial real estate storm through premium consolidation and tight liquidity.
Shedding average buildings to secure top-tier assets.
Right, to 8x8 thriving by executing that exact same demolition in the cloud. They killed off their legacy fuse tech, aggressively embraced usage-based AI, and remembered the deeply human element of enterprise sales.
It is all about clearing out the old to make room for the new.
Exactly.
But, we've covered the mechanics of how these companies are successfully navigating this transition today. But there is a broader hidden implication in all this data that I want to leave the listeners with.
What's the thread you're still pulling on?
We saw today that AI is currently dominating the micro tasks, while the number of human contact center seats actually increased.
Right.
But CEO Samuel Wilson hinted that in a few years, these micro tasks will start merging into complex macro use cases.
Oh, wow.
So when that day comes, will human seat counts continue to rise? Or are we simply living in a temporary grace period where AI and humans work side by side before a much more profound shift occurs?
That is a staggering thought.
It's definitely something for you to keep an eye on.